Hi, everybody, and welcome back to the Biz Beat by SVA, the podcast where we break down what business owners need to know about taxes, legislation, and strategies that impact your bottom line. I'm Lee Schwartz, Director of Business Development and Sales at SVA, and joined as always by my trusty co-pilot, Eric Trost, tax partner and president. Eric, we've been spending a lot of time together. We did a webinar together earlier. Scale of 1 to 10, how sick of me are you?
Not at all, Lee. You're an entertaining host to be around.
Okay, so we'll see what he says offline. All right, so thank you. Welcome, everybody. So if you've been listening the last few weeks, we've changed our format a little bit. With this new One Big Beautiful Bill legislation, we are trying to pick off a couple of different topics each week. Today, we're going to do 3. But before I get there, I want to remind everybody that we have a resource available online on our website, sva.com/OBBBA. That's 3 B's. We're putting all of our e-guides, our biz tips, past recorded webinars, and links to the podcast there. So one-stop shop for you to get all information on how this big legislation is going to affect you. So, Eric, let's talk about 3 of those big things. On the campaign trail, everybody was talking about what we're calling the big 3. No tax on tips, no tax on overtime, and no tax on Social Security. Now, we know those are just talking points. Let's kind of take those down one by one. Let's talk about no tax on tips. What does that really mean now that this legislation is passed?
Yeah, and so you say everybody's talking about it. You know, Trump was certainly talking about it. He tweeted about it and truthed about it and made it very clear. This is what I want to deliver within the One Big Beautiful Bill. And he did deliver on these, and we'll go one at a time, but he did deliver to an extent on these. So we want to talk about what that means to an extent, starting with the no tax on tips. So what happens on tips is, typically those would be reported as income and they'd be subject to Social Security taxes, and it would all go through your paycheck, even if it was cash tips. In your profession, you'd be reporting those and your employer would take care of taxes on those. That's still going to happen. So you're still going to report the tips and the employer is going to end up reporting those and withholding taxes on them and putting them on your W-2. But now there is a new step, and that is the individual who was tipped is going to be able to take a tax deduction for the tips. So it's going to be an income tax deduction, which means that those tips will still be subject to those Social Security taxes, but not income taxes. It's a limited deduction. It's not all your tips. It's tips up to $25,000. So the no tax on tips is limited, and it's also limited by income. So if you make too much income, you don't get to take this deduction. Too much income is $300,000 if you're married. $150,000 if you're single. So if you make too much income, you don't get to take that deduction. And if you make more than $25,000 in tips, the deduction is going to be limited just to that $25,000. So no tax on tips is true mostly, but there are those caveats. Now, the other thing about a tax on tips, no tax on tips, is tips have to be voluntarily given. And there's some restaurants where parties of, say, 6 or more or 8 or more, the gratuity is automatically added. Now, whether the restaurants are going to keep doing that or not, given this new policy, remains to be seen. But if the gratuity is automatically added, that's not considered a tip. You might still get, as a tipped employee, an additional tip on top of what the gratuity is that's added. So let's say there's an 18% gratuity added, and the customers leave, say, another 7%, that additional 7% will be subject to this rule. So maybe you'd have no tax on that. But the original 18% that's automatically added, that does not count as a tip because it's automatically added to the check. So no tax on tips. We have to look at it through the caveat of those rules. And there's going to be some additional reporting. So it's not just that there won't be any tax on it. It's here's the reporting. It's going to be reported as taxable, but then you get to take a deduction against those tips. And it's what's called an above the line deduction. which means that you don't have to itemize your deductions or go through any other goofy forms to do it. It's going to be right on the front page of your return where you're going to deduct those tips and subtract them off, as long as you don't have that too much income hit.
So, Eric, if you're an owner of, let's just keep it simple, if you're an owner of a restaurant, it sounds like there's some additional work you're going to have to do to make sure that your employees know kind of where everything's going. Is that right?
Yeah, that's right. So there's going to have to be some kind of adjustments to the W-2. We haven't seen the forms come out yet, but there's going to have to be some kind of adjustments to the W-2 to show where the tips are, and then separate reporting for that. So the employer is going to have to start gathering information as to what's tips and what aren't. And this didn't just start on July 4th. This is for all of 2025. So it's not like, oh, starting today or starting when the bill was signed. That's why I say July 4th. It starts, no, it's for all of 2025. So you're going to have to gather that information for the whole year as far as what the tips are, and be ready to report that in whatever format the IRS is going to ask for it to be reported on, so that it can be reported to the individuals on the W-2 and then a copy to the IRS, so the IRS knows what's going on too.
Right. The IRS needs their copy.
Yes.
So let's talk about one of the things I'm sure you get asked about all the time, and certainly people bring it up to me is, well, I don't get paid in tips. I got to figure out a way to start receiving tips so that this essentially applies to me. I'm assuming it's not going to be that easy. What are the categories where this is a slam dunk, and what are the ones where you think this is not going to be so easy?
Yeah, I think that the categories where it's a slam dunk are going to be restaurant workers and would you call it in the beauty field, like beauticians or hair cutters, or maybe there's a better name for that I'm
Yeah.
not thinking of right
No,
now.
I like that one.
Okay. What, beauticians?
Sure. I like the beauty field.
The beauty
The
field.
beauty
If you
field.
work in the beauty field, I don't often cross paths into the beauty field.
You and me both. Yeah.
But if you do work there, that'll probably be a slam dunk. Other ones will be more difficult because there's going to be a list of defined services that are subject to, what they call like traditional tipped services. So we won't be able in the accounting firm to start saying, well, we're going to charge this much for your tax return. And, oh, by the way, tips are encouraged. Hint, hint, nudge, nudge, put some money in the jar. That will be more difficult. So non-traditional tipped businesses are going to have a hard time somehow converting to a tip business. But traditional tip businesses, this should be a slam dunk for them.
Okay, great. Let's talk a little bit about no tax on overtime. What's the reality of that piece of the legislation?
Yeah. So if you recall, this was one of Trump's also, no tax on overtime. When I first heard this, and maybe other people as well, I'm thinking, well, isn't that great if I work any additional hour over 40 hours? Then that entire pay I get for that hour is not going to be subject to any income taxes. It's not quite that. It's actually no tax on the overtime premium. So overtime premium, typically time and a half. So if you make $30 an hour overtime, you're making $45 an hour, which is 30 plus half of 30. 15 is 45. So the no tax part applies to the $15 premium pay that's on that overtime. This is also limited as well. So no tax on overtime really means no tax on the overtime premium. And then there's also a limitation on this. Again, if you make too much money, which is $300,000 if you're married and $150,000 if you're single. So if you make too much money, you don't get this deduction. Now, assuming you make less than those amounts, you do get this deduction, but the deduction is limited to $25,000 if you're married and $12,500 if you're single. So again, it is a hit on the promise, but with these caveats, it's just the premium. So don't get confused that it's the entire amount. And there's these limitations on both income and then how much the deduction can be. And again, this is something that your employer, you may not see your check change, even though this is no tax on overtime, because the employer is probably going to still do all the same withholding. But now they're going to report to you differently. Hey, on your W-2, this is the portion that was the overtime premium, so that now you understand what you can deduct from your tax return for the overtime premium. So you're not necessarily going to see it right now on your paycheck. You're going to see it in a bigger refund come tax time.
Okay. And again, so you're saying 12.5 for an individual. So essentially, that's whatever your federal, whatever you're owing on your federal taxes on 12.5 is where the savings is. So potentially a few $1,000s
Yeah.
savings. Okay.
Yeah. So let's say, I mean, that's a good point, is that tax deduction essentially reduces the top part of your taxable income. So it's at whatever higher rate you're taxed at. If you're in the 25% rate, that's going to be 12,500 times 25%. About $3,000 will be your tax savings. So your tax savings is going to be the deduction times the tax rate that you're currently in. So this no tax on overtime, if it ends up being $12,000 that you're deducting, you're probably saving around $3,000 in taxes.
Okay, and then let's talk about with a lot of these things. There's mention of phase outs. Is this just a literally if you make $150,000 in $1, you don't qualify, but you make 149,999, you do?
Lee, I don't know the answer to that. So,
Ooh, I stumped him.
yes, I haven't read that part of the bill yet. Just that these are amounts that if you make over that, you're not going to get the tax deduction.
Eric, we've all seen the pictures. The bill is only about this high. How have you not read it all yet? What is
I know.
unbelievable?
I know. Next time I'm going to give you scripted questions.
Well, how about this? Next week we'll provide the answer to that. How about that?
Sure.
Okay, and let's talk next about no tax on Social Security. Again, a great talking point on the campaign trail. What's the reality?
Right. So there was also no tax on Social Security, which I think was touted and had seniors enthusiastic. That no tax on Social Security was killed for various reasons that have to do with the budgeting process and how they got the bill through. So there's some technical things going on there that a constitutional scholar could probably tell you about. But let's just say there was some hiccups along the way to actually get this through the bill. So instead of no tax on Social Security, there is an additional deduction for seniors, and that additional deduction is $6,000. So each senior gets a $6,000 deduction, which means a married couple gets an additional $12,000 deduction. That again reduces their income. It's not the equivalent of no tax on Social Security, but it is a benefit of getting a tax deduction if you would otherwise have been in a tax bracket. Having said that, this deduction also goes away. So if you make too much money on this, you don't get this deduction for the $6,000 for seniors. This one's a little lower. It goes away at $75,000 for singles and $150,000 for married couples. So if you're married and you're each collecting Social Security and you're making under $150,000, then you get a $6,000 deduction each, or another $12,000 deduction. Again, at a 25% rate, that can save you $3,000. So it's something, but it's not completely no tax on Social Security.
Right, by the letter of the law, but essentially it's designed to achieve the same goals.
That's right. Don't ask if this one phases out either.
All right.
Come across there and.
All right, just a quick question for you. How about the phase out on this one, Eric?
Yeah.
All right. No. All right. Let's move on. We have a great mailbag question to answer today. So, and I know there's been some talk about this as well. So the question we got in was, I still haven't gotten my ERC payment from the government. What's going on? Is there something I should be doing?
Right. So this is complicated. When you say ERC payment, I think what they're referring to is the employee retention credit, which was a credit designed in the COVID years. So back in 2020 and 2021, for businesses to get back employer paid payroll taxes with respect to their employees. So an employee is working, they get Social Security taxes withheld. The employer matches those Social Security taxes. The employees never see that. That just goes in by the employer. And then the employer was allowed to claim a refund of those taxes under some COVID rules if they met certain requirements. What happened was a lot of those requirements, one of those requirements, the easy one, was you had to have a decline in sales over time. And it was easy to measure. It was top line revenue. Did it go down in a certain amount? And then you could apply for that credit. And then there was another test to get these credits, which I call the government shutdown test. That's not the official name, but that's what I started calling it. And it was if the government shutdown affected your business in a certain way, you could get a credit as well. That test was actually fairly difficult and interpretive to apply. But what had happened is a number of, I'll call them pop-up shops, sprang up and started telling businesses, well, you qualify for this test. And so if you didn't meet the revenue decline test, which is easy to measure and your accountant could measure it, maybe you met this government shutdown test, which is hard to measure and is a gray area and very interpretive. These pop-up companies basically said, hey, guess what? You qualify. They hadn't seen the business yet. They didn't know anything about it. They are basically salesmen. So they came in and they sold these credits, and the IRS was inundated with credit relief for companies that didn't necessarily meet the easy test, but met this hard test. The IRS simply had no way to review all these, knew that there was promoters out there that were probably not following the rules, and they suspended processing the credits. So the good, the bad, it all got thrown in the same bucket, which was a stall bucket. And the IRS had to put a bunch of procedures in place to try to say, is this a good credit or not? They've actually slowly started processing them again. One of the changes with this bill, though, is if you filed this credit form too late, so if it was after January 31st, 2024, if you filed for a refund after that date, the IRS suspended, actually terminated any refund claims. So they're not going to send a refund if this credit was filed too late, if you tried to get it too late. They also opened up a 6-year statute. Normally the statute's 3 years. And what the statute means is, how long does the IRS have to come back and assess you money for a tax return? And normally it's 3 years after you file the tax return. If the IRS comes after that, they cannot claim any money back from you. 3 years, it's dead in the water. This credit is now 6 years. So the IRS has 6 years to investigate and try to get its money back if they think that, it was a bad claim. What does this mean to you? If you haven't gotten the money yet, that doesn't mean it's not coming. The IRS is still working through these. But if it was sent in after January 31st, 2024, you may not get that money back. It may be suspended forever. And if it was done by an agency, let's say not your CPA, but done by one of these pop-up agencies, and maybe you would know them because they probably aren't even around anymore if you try to call them. But if it was done by one of those agencies, it could be flagged and the IRS could be looking harder at it. And even if you got your credit money back and it was done by one of these agencies, you may want to revisit this with your accountant. Just make sure it's right, because the IRS, I think, is eventually intending to get around and look at these credit claims if they were done by what they would consider a promoter or one of these pop-up agencies.
Yeah, Eric, I know we were talking to our clients all the time about who was qualifying under the letter of the law and who wasn't. And then, we'd get calls from them saying, oh, this company just told me I qualify. And inevitably there were companies who were sort of led down this path that, if you're one of those companies at this point, what do you suggest they do?
Yeah, I think they've got to assess, did they really qualify for the credit? And that's where, instead of talking to the salesman company, I think just talk to your CPA and say, hey, can you review this credit for me? And did I actually have a valid claim for this credit? Because if you find out you didn't, you might want to take steps then to rectify that with the IRS.
Okay, great advice. And thanks for the mailbag question. I just want to remind everybody, you can email us at bizbeat@sva.com to submit your own question, or you can go on the podcast website at sva.com/bizbeat. But that was a great one. Thanks, Eric. Lots of great information today. Before we wrap up, I want to also remind people not just about our hub page. So sva.com/OBBBA, where you can get all sorts of information, but also a link to the webinar, the hour-long webinar that we did earlier today. We had 9 different speakers that dove into 9 different topics. It was great, but real rapid fire. So if you're thirsting for more information, that's a good place to get it. And if you found today's episode helpful, please subscribe on YouTube, Apple Podcasts, and on Spotify. Also, share it with a colleague. Share it with another business owner that you think would find it helpful. We'd appreciate it. And just a reminder, as always, we're just talking general strategy here. So for decisions specific to your business, contact your advisor. And if your advisor is not at SVA, why don't you contact me and we can talk about how to make you a client. Thanks again for listening, everybody. Have a great week. And we'll see you next week on the Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends. The Biz Beat by SVA.